Welcome to this explainer. For the past couple of years, literally just whispering AI in a boardroom or on an earnings call was pretty much enough to send a company's valuations soaring. But the data from late 2025 and 2026 reveals a completely different story. The market is maturing, and investors are demanding a whole lot more than just a slick pitch. So let's kick things off with the million-dollar question. Well, maybe the trillion-dollar question right now. Is the AI bubble about to burst? Or have we just been using totally the wrong metrics to measure its actual value? The answer, as you'll see, lies in how deeply a company integrates this technology into its core DNA.
To figure this out, we're going to quickly run through our agenda. 1. Why the AI grace period has ended. 2. The AI valuation gap. 3. Why efficiency isn't enough. 4. The product transformation premium. And 5. The ultimate investment filter.
All right, Section 1, the AI grace period ends, the free ride is over.
Check out this 2026 Global Investor Survey. It's honestly fascinating. Geopolitical tensions are obviously top of mind, sitting at 46%, which makes sense. But look right below that. AI bubble risk has surged to 19%, practically tied with market concentration at 17%. Investors are getting seriously anxious. They're seeing all this massive capital pouring into AI and asking, okay, but where are the actual tangible returns? The pure hype has faded, completely replaced by a demand for measurable operating outcomes.
And here is the core issue in a nutshell. Take company A. They're using AI for basic productivity, automating invoices, scheduling, you know the drill. Now look at company B. They are building an entirely new AI-powered sales management tool as a brand new offering for their customers. Investors are absolutely contrasting these two. Company A is barely scratching the surface, while Company B is proving real revenue-generating product growth. The market has figured out that these two companies aren't just playing different sports, they aren't even in the same league.
Moving on to Section 2, the AI valuation gap, McKinsey's private equity data.
To really grasp this gap, we need to look at how McKinsey breaks down a company's AI maturity based on private equity data. They split it into 4 distinct levels. Level 1 is opportunistic adoption, basically isolated experiments. Level 2 moves up a bit to enhancing the operating model to speed up internal workflows. Level 3 is where it gets real, product transformation, where you embed AI directly into what you sell. And finally, Level 4 is business building, creating entirely new AI-native revenue streams.
And the absolutely crucial takeaway here? This framework isn't just consultant theory. It is backed by hard valuation data from 471 privately held companies across 31 different industries. We're talking about companies pulling in revenues between $1 and $250 million. So this data completely cuts through the noise and shows us exactly what investors are actually willing to pay for at each of those 4 maturity levels.
Which brings us to Section 3, why efficiency isn't enough. The productivity illusion.
Okay, so if your company is stuck at level 1, just using AI opportunistically for basic tasks, the data shows you're trading at a median revenue multiple of 13x. That's your baseline. Sure, maybe you have a few folks using generative AI tools or you're running a couple of ad hoc pilots, but there's no real economic needle moving here. And frankly, the market knows it. Now, let's say you advance to level 2. You deeply embed AI into your operating model to make internal workflows hyper-efficient. What happens? Your multiple only inches up to a pretty lackluster 14x. I mean, that's barely a blip. You could be streamlining sales processes, automating customer service, and generating marketing content at massive scale, but the market just doesn't materially differentiate between you and the guys still at level 1.
Now hey, don't get me wrong, Level 2 efficiency is fantastic for overcoming labor constraints. The data actually shows these companies generate roughly 20% higher revenue per employee than Level 1 companies. Your operating models become way more scalable and responsive. But it's not a golden ticket. Why? Because you haven't actually changed your core business model. Your bottom line might look a little healthier, sure, but your valuation multiple stays relatively stagnant because at the end of the day, you're still fundamentally selling the exact same thing in the exact same way.
Let's pivot to Section 4, the product transformation premium, the 43% leap.
All right, take a look at the massive inflection point right here. Hitting level 3 or 4 triggers an absolutely enormous leap in valuation multiples. We're talking jumps to 20x and 31x. Just moving from level 2 to level 3 alone yields a 46% increase in your valuation multiple, and going from level 3 to level 4 gives you another 53% boost. This is not some incremental growth.
This is a literal step change in how the market perceives the future value of your company.
So the core lesson? Markets do not reward you just for operating better behind the scenes. They demand hard evidence that AI is fundamentally transforming your products and services. When you embed AI directly into what you sell, think a retail brand using virtual mirrors or a software platform deploying AI agents that act like a full-time finance team for their clients, you create a proprietary data moat. You optimize your pricing, you dramatically improve win rates, and most importantly, you actually give investors a real reason to apply a premium multiple to your revenue.
And then there's level 4, building entirely new AI-native businesses. That's where the ultimate premium lies, achieving a staggering 31x median revenue multiple. But getting there requires highly specialized capabilities and separate go-to-market strategies. You aren't just tweaking existing economics here. You're creating entirely new revenue streams. The median revenue per employee jumps by 52%, hitting $180,000. But here's the catch. It takes a massive structural commitment. You often have to treat these AI initiatives as standalone businesses, completely with their own P&L accountability and dedicated engineering teams.
This brings us to our final section, Section 5, the ultimate investment filter, capital allocation discipline.
We really need to look past the shiny AI tech for a second and realize something crucial. For intrinsic investors, the final boss of AI investment isn't the technology at all. It's capital allocation discipline. Investors are telling us loud and clear that AI has moved from just being an emerging theme to the single most cited characteristic of a winning company in 2026. But at the exact same time, they are totally terrified of management teams overshooting the target and wasting cash on flashy vanity projects.
It requires a complete mindset shift. The strongest signal a management team can send right now is that AI investment, M&A, and organic reinvestment are all governed by the exact same ROIC discipline. AI investments can't just be isolated science experiments anymore. They have to be rigorously connected to operating economics. Return on invested capital, ROIC, is the undisputed gold standard here. Whether you're expanding margins, improving productivity, or building a defensible technical moat, you have to prove to the market that your AI strategy translates into a financial reality that holds up even under macroeconomic stress.
And this bears out in the data. A definitive 63% of investors view ROIC discipline as a true hallmark of a high-quality capital allocator. It's the critical lens through which literally every AI bet has to be filtered now. Right behind that, 54% are looking for a clear allocation framework. They want to know that your AI investments are actively competing for capital against debt reduction and other organic reinvestments, and that they're winning based purely on disciplined, projected returns.
So, as we wrap up this explainer, I want to leave you with one absolutely critical question to assess your own company's future in this new reality. Are you building an AI strategy to capture the fading hype of yesterday, or are you building an entirely new product landscape that can withstand the intense, disciplined ROIC filter of tomorrow? Because the grace period, it's officially over. It is time to build the evidence. Thanks for joining me today, and keep questioning how you build value in your own organizations.